everyone, this is Demo Gonzalez of Heartwood Financial Services. Hey, thanks for tuning in again for our latest market update and outlook. As you've probably seen, a lot of things have been changing in the market here in the last month, so we'll get into what's going on there. And of course, the big question being tossed around, are we in a recession or what is going on with all that? And why is the market turning around in the midst of all that? So we'll get into all that. I hope you guys enjoy it. As always, if you have any questions, please feel free to reach out. Please feel free to share, like, comment on the videos. We appreciate it. Thank you. Okay, as always, we like to start with the asset class returns. And thank goodness for July. We finally had a good month for this market. The first half we kind of want to forget about. And there's been a big change in the narrative from the first half of the year to this next half, which we're going to talk a lot more about here in the rest of this video. But as you can see from the returns for July, we had a nice comeback with the S&P 500. Up over 9%. Small cap stocks did great too, up over 10%. So that brings the year-to-date return to still, not good, but not as scary. Real estate was up nicely, 8.5%. International lagged a little bit. A lot of that has to do with the dollar being so strong, and that might be changing a little bit too. But we're seeing developed international up 5%. Emerging markets actually still slightly negative even for the month of July. Again, this is COVID lockdowns with the zero policy, COVID policy over in China that's not helping. Fixed income had a nice little bounce back. We've seen interest rates start to drop. Remember, it's the converse of what interest rates do. So as interest rates drop, the values of the bonds go up. So that helped. High yield had one of the best months I think I've ever seen in the high yield bond market, up almost 6% in 1 month. So that was pretty impressive to see. Still negative 8+ for the year though. And lastly is of course commodities. They have been starting to slow down. Commodities here still show that they were up about 1% for the month. But that is, a small amount for how much they've gained already for the year. But that's starting to maybe roll over, and we'll be talking more about that as well, because that has a lot to do with inflation. So these are the asset class returns for July. All right, if you get nothing else from this video, I want you to understand there's a big shift happening right now. And the shift is going from high inflation to potential recession, or maybe we're already in a recession. We did just have 2 negative GDP prints, and that has technically been the definition for a recession in the past. Of course, there's a lot of other things that play into that. The pandemic has thrown GDP numbers off quite a bit, so you could debate both sides of this, and I'm not going to get into it. But the major thing here to remember is recessions can usually do a good job of lowering inflation. All right, so that means the Fed is actually starting to get what they want. They're lowering inflation potentially by slowing down the economy, and hopefully they just don't slow it down too much and create a major recession. Now, that's always a concern, and it's they don't have a very good track record for making these little soft landings, which everybody hopes will happen. And I'm in the camp that probably won't happen either. We'll probably see some sort of recession if we're not already in one. But here's the main illustration I wanted to show you of this. You see, this is the commodity prices going up. And in June, when that last CPI number came out, it was the end of June. So it showed a lot of these high commodity prices, which is why we got such a high commodity or a high CPI print at 9.1. But you can see how it's come down quite a bit. In fact, we're pretty close to where we were pre-Ukraine-Russia war, which is pretty interesting back in late February. So we're starting to see that shift going from inflation to recession, and that's actually been helping the Fed maybe tamp down inflation, and that's one of the reasons why we're seeing the market kind of react the way it's been reacting here recently. So here on this slide, I want to quickly talk about the yield curve. The yield curve is showing what interest rate you get at different maturities, and it usually looks like this gray line here, okay? And what's been happening recently is this blue line. See, this is the number as of the end of July. You can see that it goes up like normal, but then it's kind of flat, and then it actually inverts. And this is what's called an inverse yield curve. You get paid more for a 1-year treasury than you do for a 7 or even a 10-year treasury. This is ridiculous, right? Why would anybody, want to get paid less and have the commitment for a longer term maturity? Well, again, this is showing that more people are becoming more and more concerned about recessions than they are the yields going up because the Fed is worried about inflation. They raise interest rates. So again, you're starting to see that shift going from inflation. Now it's still there, but it's becoming less of a concern and more towards recession. And so when you look at this yield curve, the yield curve is actually telling us that the marketplace feels like the Fed is going to probably not raise rates too much more at the end of the year and could possibly even be lowering rates later on in the next year or so. And so that's why people want to go ahead and lock in these longer term yields, even though they're lower than those shorter term yields. And so how is this a potential green light for the market? Well, remember, the biggest concern the market had was the Fed was going to raise rates. They were going to slow down the economy so much that it was going to create a recession. That's usually how recessions happen. There's a few times when there's wars and pandemics, but usually it's the Fed slows down things to create a recession. And so if they're starting to see the end of that cycle of raising rates, maybe in the horizon, the market is getting optimistic for that possibility. Okay, now I also want to show you another element of what's keeping people a little bit more optimistic and why the market has been hanging in there pretty good. In fact, it's been bouncing back a little bit. What happened over the last 6 months, as you can see here, the S&P 500, now this goes to June, I haven't included July here, through June, the market was down about 20%. And what's interesting is the S&P 500 earnings of the companies themselves has actually been going up. So you would think, well, if the market's going down, that's because earnings are going down, right? Well, that's actually not what's been happening. It was being anticipated that it could happen, but it actually hasn't happened yet. Earnings have been, that's the name here, hanging tough. What we've seen is what's called multiple compression, meaning the PE ratios are getting compressed where they used to be way up here at 22 times, okay? And now it's down to a more historical level of 16 to 17 times. So one would say, yeah, the market's been going down, but it's not because stocks are bad. It's because the environment has been bad and stocks have been actually pretty tough. So another way to look at this is stocks have been getting cheaper, but for the wrong reasons. So it's a good time to look at stocks because they're a lot more attractive than they have been in the past. So one of the reasons why you're seeing a little bounce back here potentially as well. All right, so I've mentioned recession a few times, and maybe this is throwing you off a little bit. Demol, the market's anticipating recession. The market's doing better. How does this jive? Yeah, it can be a little confusing. You got to remember, and I want to show you in these charts here, that the stock market is reacting to what is going to happen in the economy in the future. So they're trying to predict what's around the corner, not what's happening right now. Because right now the economy is slowing down, and it appears like we could be going into a recession, but as we saw just on Friday, the unemployment numbers were twice as high as we anticipated. So there's still a lot of strength out there in the marketplace. We also had a really strong ISM number that showed manufacturing and services still pretty strong. And so how can this be a recession? Well, we've had those two negative GDP reports, and that certainly makes it feel like a recession. So that's the conflict that we're all debating right now when you're watching the news. But let me show you how this forward-looking works. This is the GDP, okay, back in early 2020, and this has happened, several times before. Another good example was in 2008. And then this is a chart that has the exact same scales. You can see how the market bounces back in the midst of the recessions. So you can see right here, the market was bouncing back in 2020 in the middle or right at the beginning of a recession or right in the middle of a recession. And so these two charts are here to basically demonstrate that the stock market is not the same as the economy. The stock market is something that's looking ahead. And so maybe the market had been pricing in this slowdown and by most counts probably a recession that's going to be coming or maybe already here, but it's already kind of priced a lot of that in. The real question is, has it priced it all in? And of course nobody knows that for sure. I'm in the camp that there might be a few more hiccups along the way, but it does look like, especially if the inflation numbers do start to roll over and go down, that maybe we've gotten through some of the worst parts of this market correction. All right, I wanted to show you this slide here. First of all, it's very educational. Most people don't realize that when you look at the CPI, which is that consumer price index number that comes out every month, it's been a pretty big deal over the last several months because of inflation, that the biggest component of that is this owner equivalent rent, which is basically shelter. Okay, so most of the inflation numbers come from housing. All right, and so this is one of my biggest concerns that I don't feel is going to be fixed right away, even if commodities are coming down. Housing has not been coming down yet. It might be lagging, which means that it might take longer than some of these other inflation components to come down. This is rents, okay? Rents have been going nothing but up and up and up and up, and it still hasn't rolled over and may not roll over for a while. Now, there are some signs of hope. I'll show you here. The silver lining is, in this chart here, you could see that there are more prices starting to come down, or price drops, I should say, in homes for sale. So is that the precursor to maybe housing starting to get a little bit more affordable and maybe finally those rents to start to go down? I hope so, but my concern is that yes, we might have inflation come down a little bit, but then it's going to kind of plateau because of housing. And inflation at 5% at the end of the year is still way too high. So this is probably one of my biggest concerns, that the Fed might still feel that they have to continue to raise rates even though a good bulk of inflation has come down, but because inflation is still not down enough. Remember, their goal is to get inflation down to 2%. It may be quite a while before we get inflation back down to 2%. Okay? All right, the last piece is always the Heartwood implications. So what are we doing to deal with all this change in narrative and the potential changes that are coming down the road? And so I would say right now, because I do feel like a recession, at least a mild one, seems to either be here or coming in the near future, I have been adding a little bit more to higher quality and a little bit longer term duration bonds. The bonds is part of that, the conservative part of the portfolio. It was a little bit more on the inflation hedging type side of that equation. Now we're going to more conservative bonds that have higher quality and maybe are a little longer in maturities. So on that side, that's what we're doing. On the stock side, actually going a little bit more to growth style stocks from more of these cyclical style stocks. These tend to be a little bit more tech and growth oriented. So when recessions occur or when slowdowns occur, you want things that can grow, and technology type stocks tend to be that type. And then also on commodities, I've been lowering the commodity exposure and adding a little bit more to gold and a little bit more to fixed income to kind of counter the fact that commodities look like they're peaking and starting to come down. Now, because I still am concerned that inflation is not completely going away, but will maybe plateau for a little while, we're not getting rid of the commodities. We're just lowering that exposure, still keeping some inflation protected bonds, but lowering the exposure overall. Okay, I hope this helps. Thank you for watching. Please feel free to share the video. If you have any questions or concerns, you can always give me a call. Thank you very much. Bye-bye.